33%. That is how much the coverage ratio between COMEX silver futures and registered warehouse supply has tightened in a remarkably short period of time. And when you run the math on it right now, it leads to a question that a lot of investors holding physical silver are quietly asking themselves this week. How does a market trading at $73 an ounce function when the deliverable inventory behind it is barely over 100 million ounces? Last week I asked you to watch a very specific number in the futures market, the positioning in the front-month silver contracts, because if the open interest stayed elevated while registered inventory remained tight, the coverage ratio would start to look uncomfortable. While the latest CME warehouse report shows registered silver sitting around 103 million ounces, while May futures contracts imply roughly 5 times that amount in potential claims. Now, before anyone jumps to conclusions, that does not mean 5 times more people are demanding metal than exists. Futures markets do not work that way, but the ratio itself is worth paying attention to because it tells us something about how much paper exposure exists relative to deliverable supply. My name is John, 15 years working inside currency and commodity markets before I ever picked up a camera. And the reason I started making these videos is simple. I watched too many retail investors trying to interpret these markets through headlines instead of through the actual data. Everything we are going through today comes from publicly available reports: CME warehouse data, CFTC positioning, Reuters industrial demand estimates, and a few others. And what I want to do is show you 3 things. First, what is actually happening in the silver futures structure right now. Second, why the falling dollar is amplifying the move we are seeing in metals. And third, what this combination of factors realistically means for someone sitting at home holding silver today. And if calm, data-first analysis like this is what you have been looking for, hit the like button now, because that feedback genuinely tells me to keep producing these breakdowns, and if you are not subscribed yet, this is exactly the type of week where following the data matters. So let us start with where the market actually sits at the moment. Silver futures for the May contract have been trading around $73 per ounce, which is a move that a lot of people felt in their portfolio if they have been holding physical metal. 3 weeks ago, silver was significantly lower, and what changed in the background is something most headlines barely mentioned. The US dollar index quietly slipped below the 100 level, landing around 99.9, according to the latest market data. And when the dollar weakens, it mechanically changes the pricing dynamics for globally traded commodities like silver and gold. But the real conversation this week is not the price itself. It is the structure of the futures market behind that price. Think of the COMEX silver market like a stadium full of people holding meal vouchers. Every voucher represents the right to potentially claim a hot dog at the concession stand. Now imagine the stadium holds 50,000 people, but the concession stand only stocked 10,000 hot dogs. That does not mean everyone rushes the counter at the same time. In fact, most people never even try to redeem the voucher. They trade it to someone else or simply leave the stadium before the game ends. That is exactly how futures markets behave. Most contracts are closed or rolled before delivery. But the interesting part is watching how many vouchers exist compared to the number of hot dogs actually available. And right now, that comparison, what traders call the coverage ratio, is drawing attention because registered COMEX inventories are sitting around 103 million ounces, while front-month futures exposure implies a much larger potential claim. According to the latest CME warehouse report, that ratio is approaching roughly 5-to-1 for the near contracts. Again, that does not mean a crisis, but in 15 years watching these markets, I can tell you that traders do start paying attention when the gap between paper exposure and physical deliverable supply becomes visually large on the balance sheet. Now here is where the second layer of the story enters. Reuters recently summarized the Silver Institute's ongoing supply-demand estimates, and one point in that report keeps showing up year after year. Global silver demand has been running in deficit relative to mine supply and recycling for several years now. That deficit does not function like a countdown clock. It is more like gravity. Gravity does not tell you the exact moment something falls. It simply tells you which direction the pressure is building. And the direction of pressure in silver demand has been upward because the metal is quietly embedded in technologies that are scaling at an extraordinary pace. Solar panels, electric vehicle electronics, advanced circuit boards, medical connectors. Silver is everywhere in those systems because it conducts electricity better than any other metal. The interesting challenge is that each individual device only uses a small amount, but when you scale millions of devices, the cumulative demand becomes significant. Picture trying to recycle sugar that has already been dissolved into a giant swimming pool. Technically, the sugar is still there. Practically speaking, it is extremely difficult to recover. That is one reason recycling silver from electronics is not nearly as efficient as recycling larger metal components like copper pipes or steel beams. Now, before we let the bullish narrative run away with itself, there is an important balancing point. Futures markets are incredibly good at adjusting before a true delivery problem occurs. Traders can roll contracts forward into later months. They can hedge exposure with options. They can simply close positions. And according to the latest positioning data reported by the CFTC, institutional traders have indeed been shifting exposure away from the immediate delivery window and into later contracts like July and September. Think of it like tenants in an apartment building who know their lease expires soon. If the landlord suddenly raises the deposit requirement, they might not abandon the building entirely. They might simply move their lease start date to a later month. That is essentially what rolling futures contracts accomplishes. It pushes potential delivery pressure further down the calendar. But here is the twist that has analysts watching closely. Physical silver pricing in Asia has recently been trading at a noticeable premium compared with Western futures benchmarks. Data referenced in recent market coverage shows Shanghai prices running several percent higher than COMEX equivalents. Now, before anyone runs with that number as proof of a shortage, premiums can reflect a lot of things: taxes, local financing conditions, regional demand patterns. But when premiums appear consistently, they do create an incentive for traders to move metal toward the higher-priced market. It is simple arbitrage logic. If copper sells for more in one city than another, traders eventually ship copper toward the higher price until the difference narrows. Silver markets function the same way. The geopolitical backdrop adds another layer. Central banks around the world have been steadily increasing gold reserves for years now, according to the World Gold Council's latest surveys. And while those purchases involve gold rather than silver, the message they send about currency diversification matters for the entire precious metals complex. These institutions are not day traders watching 5-minute charts. When a central bank adjusts its reserve composition, it is usually thinking in terms of decades rather than days. Meanwhile, the fiscal picture in the United States and the United Kingdom continues to tighten in ways that investors are starting to notice more closely. Treasury borrowing projections, released through government budget reports, continue to show rising debt issuance, and the Bank of England's reserve data combined with activity tracked by the London Bullion Market Association still confirms that London remains one of the central physical hubs of the global bullion system. De-dollarization, a term that gets thrown around far too casually online, is not a Tuesday event. It is a slow, structural evolution measured in years and decades. But the direction of travel in global reserve diversification is clearly visible when you step back and look at the long-term charts. Now let us talk about the industrial layer because this part is often misunderstood. Silver demand from technology and energy infrastructure has been expanding, particularly with solar installations scaling worldwide. The Silver Institute's demand studies have repeatedly highlighted the growth in photovoltaic manufacturing, but I am not going to give you a neat little number like X ounces per megawatt, because that would be false precision, and you deserve better than that. Manufacturing processes evolve constantly. Engineers are always looking for ways to reduce metal usage per unit through a technique known as thrifting. The real takeaway is not the exact grams per panel. It is the direction of the demand curve, and that direction has not reversed. When you combine expanding industrial use with investment demand cycles, the silver market becomes extremely sensitive to shifts in liquidity. Which brings me to the framework I personally use to filter the noise. I call it the 3 lanes framework. Think of it as 3 parallel roads moving at different speeds. Lane 1 is the paper market, the futures contracts, margin requirements, and trader positioning tracked in reports like the CFTC's Commitments of Traders data. Lane 2 is the physical market, vault inventories, retail premiums, and wholesale flows through hubs like London and Shanghai. Lane 3 is the macro environment, interest rates, currency strength, fiscal policy, and global capital flows. When all 3 lanes start pointing in the same direction, markets can move very quickly. In 15 years watching currency and commodity markets, the moments when those lanes align, even briefly, have historically produced some of the most powerful moves in metals. I am not saying that alignment exists today. What I am saying is that it is useful to know what signals would confirm it. This week, the paper lane shows a futures structure with a relatively tight inventory ratio. The physical lane shows regional premiums, and steady withdrawals from vault systems according to recent warehouse data. And the macro lane shows a dollar index that has slipped under the psychological 100 level while global debt issuance continues climbing. When the paper lane, the physical lane, and the macro lane all lean in the same direction, historically the outcome has often been increased volatility in precious metals pricing. Again, that is a framework, not a prediction. So here is the one thing I am personally watching this week. Just one. The next update to COMEX warehouse inventory and the front-month open interest levels as we approach the delivery window. If the inventory number holds steady while open interest declines through normal contract rolling, the market is functioning exactly as designed. But if open interest remains elevated while registered inventory continues shrinking, traders will start paying much closer attention to delivery dynamics. This is my one call for the week, John, FX Insider, on record. I will be back next video to tell you exactly what happened. No edits, no excuses. That is the only way this works. Now here is where I want to be completely straight with you, because this is the part where many channels simply choose a narrative and ignore the other side. The optimistic scenario for silver is that industrial demand growth, continued deficits, and a weakening dollar environment gradually tighten the physical market over time. But the cautious scenario is equally real. If equity markets experience a sudden liquidity shock, the kind that forces leveraged traders to sell assets quickly to meet margin requirements, silver can fall very quickly, even if the long-term fundamentals remain intact. Think of it like a tenant who loves their apartment but suddenly faces a huge unexpected deposit requirement. They might still want to live there, but if they cannot raise the cash immediately, they are forced to move. Margin calls work the same way in financial markets. Both outcomes are genuinely possible in the current environment. Your job is not to emotionally commit to one scenario. Your job is to watch which conditions are actually unfolding in real time. Before we close, the disclaimer you need to hear, and I mean it. Everything in this video is educational content based on publicly available information. Currency Insider does not provide financial advice, investment advice, tax advice, or legal advice. Nothing here should be construed as a recommendation to buy, sell, or hold any asset. Past market behavior is not a guarantee of future results. Always consult a qualified financial professional before making investment decisions. Before the two questions, if you got value from this today, the like button takes 1 second, and it genuinely helps this channel reach people trying to navigate these markets without all the noise. Now I want to ask you two things, and I genuinely want your answers. First, if you are holding physical silver right now, are you seeing higher premiums at your local dealer compared with earlier this year, or has pricing stabilized where you are? Second, based on the 3 lanes framework we talked about today, which lane do you personally think matters most for silver over the next 12 months? The paper market, the physical market, or the macro environment? Drop both answers below because the comment section becomes a real-time sentiment tracker, and I read every single one. Subscribe because next week we are going deeper into how to interpret the CFTC positioning report. Once you understand that document, you start seeing market shifts days before the headlines appear. And if someone in your life is watching the metals market right now and trying to make sense of what is happening, share this with them. That is the whole point of this channel. This is Currency Insider. Know the market, protect your currency,